Hello and welcome to NDTV Profit. You're watching Know Your Company, a show designed to give you regular investors powerful, actionable insights into the fundamentals of a single NSE listed company every day. On our radar today is Baazar Style Retail. If you pull up the stock as well, it's very interesting to see what's happened because it's a recent listing. In fact, I think one of the days that was on the 20th of February itself, the stock had seen a major rally that had come in as well on this counter. Now, with regards to Baazar Style Retail, value fashion brand which was established in 2013, the company is based out of Kolkata and clearly they are market leaders in that particular region. So if you talk about West Bengal and Orissa, that's where their hold is. Their key focus areas are Tier 2 and Tier 3 regions, and that's where they're aiming to enhance their presence as well. What do they offer? It's mainly apparels and general merchandise. And the options range from men's fashion and women's athleisure wear as well. They also have a general merchandise segment. So that's with regards to where Baazar Style Retail goes. A pretty, I mean, if you have to compare it to other players, a small regional player, but the key is going to be with regards to where expansion, etc. go. But moving on, let's quickly look at the parameters that we will be considering in trade today. Firstly, a check in terms of their income statement. So this will take into consideration their revenues, their profitability, as well as their operational metrics as well. So that's a rating that we will be considering. The balance sheet will be checked as well on the back of our parameters. We will be looking at their cash flows, the return ratios. How does it stand in terms of shareholdings? What is the FI and DII view on the counter? And what the promoters have done so far. Apart from that, if you see in terms of the other parameters, we should be looking at the street credentials, the valuation picture as well. So these are the 8 parameters that we will be watching out for. But first, let me welcome in Mahima, my colleague as well. Mahima, to start off with, firstly, if you see in terms of the income statement, the 3 metrics that we could pick up on that front, what are they actually indicating in terms of the numbers?
Right. So, Hiral, in terms of the income statement, definitely it's a thumbs up for the counter. In terms of revenue, the 3-year CAGR for the revenue has been around 32%. 9 months FY25 number also stands at 998 crores, which has crossed the FY24 number mark already of 973 crore. In terms of the EBITDA, EBITDA has had a 3-year CAGR of around 46% nearly. And even in terms of EBITDA, the number for 9 months FY25 has crossed the FY24 number of 142 crores. It now stands at around 150 odd crores. Margins have improved a tad bit as compared to FY24. FY24, the margins stood at around 14.6, whereas they've now improved to 15%. And PAT is very close to where the FY24 number stands. It stands at around 21 crore right now versus that of 22 crores in FY24. But, you know, since this is a, fashion retailer, some key important metrics that one should watch out for in terms of 9 months FY25. The number of bills went up by around 39% for the company. Quantity sold has gone up by 36% for the company. Average transaction value, however, slightly has come down. But sales per square feet has gone up by 9%. Same store sales growth for 9 months FY25 has improved from 5% to 10%. In terms of sales mix right now, in terms of 9 months, in terms of FY25, around 87% is apparels and 13 odd % is general merchandise. In terms of the difference, the breakup between men, women and kids, in 9 months FY25, men is around 42% of the company, women is around 30% of the company, and remaining 28% is kids. In terms of the sales mix, lastly, in terms of 9 months FY25, private label stands at around 44 odd %, and the revenue coming in from others comes at around 56 odd %. And in terms of the breakup between core market and focus markets, core market is around 86% for the company, and remaining 14% is where the revenue from focus markets is coming on. So in terms of operational metrics and as well as sales mix also, the company seems to be strong, which is why, in terms of the income statement parameter, we've given a thumbs up.
Right, so that's with regards to where the balance sheet, the matrix in terms of the financials, the income statement go. But let's quickly look at the balance sheet as well. Let's look at what the numbers are looking like. If you see in terms of the cash and cash equivalent, that has seen a steady growth. If you talk about FY24, is what is at 15 crores. But in the first half of FY25 itself, they've managed to nearly reach around 60 odd crores. So a good move on that front. The gross debt has come down substantially from a 29 crores in FY24 to a 3.6 crores in the first half of FY25. And I'm assuming this is because they have repaid some portion of their debt from the IPO proceeds as well. And in terms of the net worth, which was at around 215 odd crores, it's come to around 380 crores in the first half itself. So a good number with regards to the three parameters on your balance sheet. And that is one of the reasons why we're giving a thumbs up on the balance sheet front as well. But to add to this, we are seeing a 60 crore cash and cash equivalent. What are the cash flows indicating, Mahima, so far from here on as the next parameter?
Right. So in terms of cash flow also, I mean, if you see the parameters, it looks like a steady growth. I mean, none of the cash flows are in negative when it comes to all three, aspects. When it comes to the operating activities as well as financing activities, it's only the investing activities where there's a negative number, but that's probably because they're investing more and more into the stores, and they're kind of expanding when it comes to the store expansion. In terms of the numbers, cash flow from operations in FY24 stood at around 1112 crores. In first half of FY25, this number is 68 crores. So it's pretty much, almost half of what FY24 did. So it will probably end in the similar levels at which FY24 ended. And in terms of the net cash flow as well, from all the three activities, as you're investing, your financing and operation activities, FY24, the number stood at 89 crores, which is around 44 crores. So again, almost half of what it had done in FY24. So even the second half will probably pan out the same way, and the overall trajectory, even in terms of net cash flow, will be similar to that of FY24 in terms, which is why the cash flow trends have remained stable, and which is why we've given a thumbs up when it comes to the cash flow.
Right. So that's with regards to where the cash flow goes. Now let's understand what the return ratios are telling you from here on. Now, if you talk about the return ratios, in FY23, the return on equities was around 3%. It's come up to double digit in terms of FY24 at 10.7. In terms of the ROCE as well, from 13.8% to 18.4%. Those are the two numbers that we're tracking in terms of the ROCE. But what's interesting over here is, it's been, as compared to peers, it's on the lower side, right? And that's the reason why it's a thumbs down. But if you have to look at the company from an improvement perspective, it seems to have a steady improvement in FY23 and FY24. And probably the FY25 so far also is on the similar lines. But as compared to peers, it is lower. And that's the reason why we've given it a thumbs down in terms of return on equity as well as the ROCE.
Absolutely. And even, generally, when it comes to the return ratios, we generally expect, Hiral, that a 20% mark, if the return ratios cross, is a better, ratio to track. And that is also one of the reasons why we've given it thumbs down. And in terms of the shareholding pattern overall, Hiral, it's a well-held company when it comes to the promoters. Although the promoters' holding is not more than 50%, but it stands at around 46 odd percent. In terms of the FIIs, they've reduced their stake a tad bit as compared to September, because it's a newly listed company. We only have data for September and December 2024. FIIs have gone down from around 6.5 to around 6 odd percent there. DIs, however, have increased their stake from around 9.9, that is around 10% to around 10.4 odd percent. And public, however, has sold a tad bit between September to December quarter. So it's gone down from my bad. So it's basically they've increased the stake that tad bit. In terms of September 24, it stood at around 38 odd percent, 37.9 odd percent, and it's increased by a tad bit to around 38.02%. But overall, this is the picture when it comes to shareholding. Promoters have continued, at least in the past 2 quarters, to keep their stake alive.
Right. And what's interesting over here to note is also that the free float is increasing marginally, right? So there is retail participation which is increasing. But the key question over here that comes up is, taking the stock price into consideration, are retailers stuck with the counter? because that becomes crucial. You have DIIs which have marginally increased, FIs, a marginal reduction that has come in, as you mentioned.
Right.
So if you see the next parameter, though this is also a thumbs down, if you see the street credentials on a YTD basis, the stock is down nearly 33%. If you go to the next parameter, that will tell you in terms of what the street is talking about. There you go, YTD returns 33%. Now, just to give you some context, clearly Bazaar Style Retail, on the 20th of February itself, it gained more than 20% in trade. Now, as we know, the stock was listed on the 6th of September 2025, right? On listing day, it saw tepid gains of around 2.5 to 3%.
Right.
And it touched a high of around 372 or 373 in the month of December. But after that high, the stock has been on a declining trend from here on. A low of around 181 is what Bazaar Style Retail saw. So it's interesting to see that the street credentials are pointing out to a thumbs down, mainly on the back of the way returns are panning out. Right. 33% downtake. Now, with that 20% up move that we saw on the 20th of February, it was just a one-day move. I mean, the retail participation now needs to figure out as to whether they need to be invested in the stock or not invested in the stock because of the way the returns are panning out and what their expansion is going to be from here on.
Right, absolutely. And, this is despite, this kind of returns are despite the kind of way these retailers have performed in Q2 and Q3. The festive season was very well in terms of its Q3 numbers, but still the stock has not done as much as, the company has performed. And probably, it's the second half that will probably see, the last quarter we'll have to wait and watch out for as to how it performs.
Yeah, and because I think in the previous quarter numbers also, the Durga Puja, that could have been accommodated. Correct. There was in the previous quarter and the second quarter, right? So your Q3 automatically was weak. But if things pick up, the expectation is that Q4 could be blockbuster and that could be the turning point for the company.
Absolutely. And especially because it is, West Bengal focused. Absolutely. And Eastern markets focused. Now, the next parameter is the valuations part, in terms of the EV to EBITDA number, when we compare Bazaar Style to its like peers like V2 Retail and V-Mart Retail, Bazaar Style's EV to EBITDA stands at around 16.4% versus that of almost 25% for V-Mart, and for V2 Retail it's even higher, which is around 37%. So, as compared to peers, right now Bazaar Style is definitely looking cheaper when it comes to valuations part, which is why, in terms of valuation when compared to the peers is a thumbs up. I have not compared this to, something like a trend, because trend is very big to be compared to a Bazaar Retail Style because it's only focused in the Eastern markets. But V2 Retail and V-Mart Retail are the other two players that are focused in the tier 2 and tier 3 cities, and comparatively are small players, and the market size of their overall portfolio is similar to Bazaar Style Retail, which is why their like peers include V2 Retail and V-Mart Retail, but are much expensive as compared to where Bazaar Retail Style
Absolutely.
stands.
So the question is whether there is value in looking at a Bazaar Retail, or it's best to stick with the expensive names, taking into consideration the performance. So that's the dilemma here. But let's now look at the final performance rating that NDTV Profit would give a Bazaar Style Retail, right? I mean, 3 thumbs up in terms of income statement, balance sheet, cash flow. Return ratios is a downer, and this is as compared to what peers are doing. If you look at the other ones as well in terms of the KYC performance, again, 2 thumbs up a shareholding is a thumbs up, valuation is a thumbs up, street coverage is neutral because there is no coverage coming in there. And in terms of the street credentials, a downer because it has underperformed as well. So clearly it's a 5.5 rating for a Bazaar Style Retail so far, and from a 8, and this is mainly taking into consideration their performance and what they've done as compared to peers as well. But with all of this, very quickly, let's understand the SWOT analysis as well. Mahima, if you can go ahead with what are the strengths or the weaknesses that you're seeing?
Absolutely. So in terms of strength, definitely it's growing very fast when it comes to a value retailer, and it's accelerated its store expansion by quite significantly, which we also saw in their cash flow statement, because their overall investing activity is a negative cash flow. And in terms of their cost structure, it is quite lean, and it has high operational efficiency. It's maintained its margins, which is why the strength is these three things, basically fast growing, accelerated store expansion, as well as high operational efficiency and lean cost structure. In terms of weaknesses, it's present mainly in the eastern region. It's not expanded in multiple regions of India. That is one of its weakness. And the average transaction value is one thing, one operational metric which has come down, which would kind of overall impact the margins as well as the top line going ahead, as well as the bottom line. Because if your average transaction value comes down, it will definitely have your impact on the profit and loss statement. So that is where weakness is concerned. But with respect to opportunities and threats, Hiral, what are you reading?
I mean, it's interesting to see if you talk about the opportunities. Yes, they have plans in the tier 2, tier 3 cities, right? So that is one of the parameters that we should be watching out for. The expansion in terms of other markets in India and rural consumption picking up is what will aid their expansion in the tier 2, 3 cities. Plus, the Bangladesh plus one strategy is also expected to play out really well for them. So these are opportunities that you should be watching out for. In terms of the threats, there could be competition that could be coming in from other retailers and bigger players like Trent, right? So how fast they are able to grow and capture market share is the key over here. So that becomes one of the threats. And very lastly, less focus in terms of the urban markets is something which will probably be a threat to them as well, because consumption in the urban market is also not picking up. And plus, it's not a market that they're focusing on. So that probably impacts their average selling price as well, right? If you have to compare rural versus urban. So that can be an impact in terms of the margins as compared to peers. Let's put that into perspective. So those are the clear opportunities and threats that we are looking at so far. Thank you, Mahima, for breaking this up for us. But let's also now shift focus to the management. We're joined by the Managing Director, Shreyans Surana. Mr. Surana, firstly, good afternoon. Given that the company is just listed probably 6 months ago, let's first start with understanding where will your business moat lie? Because you are a value fashion retailer in East India. What are your expansion plans going forward? Do you plan to expand in other markets or stick to your core regions?
I think, as I said in earlier interviews also, we will stick to our cluster-based approach, in which our main focus will be from central India to northeast part. Currently, we are in 9 states. Majorly the core states that we work on is Assam, Odisha, and Bengal. And the focus are more on Bihar, UP, and Jharkhand cluster. So we'll be keep opening stores in both the clusters. If you see for the first 9 months also, we have opened around 37 stores, out of which 22 stores have been opened in the places like Odisha, Assam, and Bengal, and 15 are part of UP, Bihar, and Jharkhand cluster.
Okay, so what is the kind of capex that you have lined up for the next 2 years, taking your expansion plans into consideration?
In the first 9 months, we have grown at a rate of 30%. As a company, we have a clear strategy in which we are working on a balanced growth approach, in which we will be eyeing a revenue target of around 25% and L to L, same store sale growth target of around 7 to 8%. So we'll be opening around 40 to 50 stores every year. Typically, a store takes a cost of around 1 to 1.25 crores while opening. While saying that, we are focusing on our back-end operations also. So for this current year, we are targeting to invest in warehouse capacity expansion, along with a lot of investment going in the technology part on the warehouse management solutions, inventory management solutions, and on the ERP.
Okay, so that's your capex. Now, when you talk about targeting, say, 40 to 50 new stores annually, what's the rationale behind that? Why 40 to 50? And how would you plan to ensure a sustainable growth without seeing any pressure in terms of margins?
So basically, in past years also, we have grown around at a rate of 24 to 25%. So 40 to 50 stores is at a sweet spot, which allows us to have a healthy growth of around 25%, in which LTL growth of around 7 to 8% comes in. For this year, it is around 10%. So if your same stores are growing at around more than 7 to 8% in a financial year, it gives you a healthy margins. So it mitigates the revenue or the PAT loss given by the new stores. And as far as the store expansion is planned, because we are opening in our existing cluster geographies only, which help us to have a better understanding about our catchment. Typically, we know what is going to sell, which merchandise is going to sell better in this particular state because of our larger experience in that particular state. It allows us to open stores freely.
Okay. And if you talk about the same-store sales growth rate, how sustainable is the current rate? And what are the strategies that you have in place to probably either maintain it at current levels or see an improvement from here on?
So there are two things. If you see past years also, last year FY24 also we have grown at a rate of 9.5% in SSG. Before that also it was around 17%, and the current financial year also we have already delivered around 10% for the first 9 months, and we expect to close above 10% in this financial year itself. So we are able to generate this SSG condition on the two account. First thing is there is a huge traction coming from unorganized to the organized market. Second thing is there's a down trading going from the higher price bracket to the lower prices. And third thing is in terms of experience. So we give experience on three things to the consumer. One on the product, second thing on the prices, and third is on the ambience of the stores. We open a store of around 8,000 to 10,000 square feet, typically in tier 2, tier 3 stores, fully air conditioned. You get an exchange facility over there. You get an omni channel service also. You can deliver it to your home also, the articles that you like. We have got more than 70 people in our merchandising and quality team, which works day in and day out to maintain the quality and designing at an affordable pricing. I think all these factors leads to a higher footfall in our stores, which ultimately leads to a higher sales.
Right. So approximately, I believe 66% of your total store area is located in tier 3 and 4 cities. Is this the strategy that you will continue, or are there plans to expand into tier 1 cities as well?
So it will be a mix of both. For example, this current year, we have focused a lot on the cities like Kolkata for this financial year. And I think it will be a mix of both. But yeah, largely the target will be in tier 2, tier 3, tier 4 only.
Okay. And over the last 3 years, despite these macro headwinds, now Star Bazaars, if I have to look at the store revenue, EBITDA, they've grown at around 24%, 33% and 44% respectively. And the same-store sales growth has remained really healthy, right? So should investors expect similar growth rate going forward? Or if you have any guidance that you can give on that front?
So we generally operate ourselves on the pre-Ind thing. So I think for this year, we have already done 82.5 crores in terms of pre-Ind EBITDA for the first 9 months on a revenue of around 998 crores. For this year, the guidance would be around again 7 to 8% only. We target between 95 to 98 crores of pre-Ind EBITDA for this financial year. And I think, as I said, for the coming years, the target is very simple. We will be eyeing a growth of around 25% with an L2L growth of around 7 to 8%, with opening 50 to 40 to 50 stores every year.
Okay, so that's what store opening. But when you talk about costs, do you have any strategy in place to lower costs, or will the margins continue in the same range of around 7 to 8%, or do we see them going to double digits?
I think there's a lever to increase these margins rather in future, but because we are focusing more on expanding our territories, expanding the market zone that we are in, so we are not increasing the gross margins right now. But I think this is a healthy and sustainable EBITDA margin that we are earning right now, and we will continue to do this in future also. And there's a lot of room going forward, and we will be trying to, as I said, 7 to 8% will be the range where we'll be going in coming years also.
Okay.
In terms of EBITDA achievement on pre-Ind AS.
Okay. And if you talk about the private label part of your business, that has been consistently increasing, right? So what is that margin differential between private labels as compared to other goods? And if you have to say, probably look 2 years down the line, how much will private labels contribute to your sales mix, and what's the impact you will see on margins?
So currently, private label stands at around 44%, and right now we are not. It's just on 50 bips, which is higher margin on the private label, because our target is to reach to all the consumers. We just want that our private label experience goes to the all the customers and so we are not increasing a very high margins. We are not eyeing a very high margin right now in the private label. Right now, we just want to consolidate the private label expansion that we are doing. Ultimately, next 2 years, our target is to reach around 60% of our revenue coming from private labels. And going forward, we will increase the margins in private label once the private labels gets established among the consumers of tier 2, tier 3, tier 4 towns.
Okay. My last question coming to you is, despite the IPO fundraise, which was probably used towards debt repayment, there's still a debt of close to 100 odd crores. So why so? How much more can this increase to? And what is that comfortable level as per the company?
So basically, the net debt is around 85 crores as of 31st December, and the major reason for that is that we have a fire in the month of May. The insurance claim is still awaited, and but we have to pay our vendors, so we had paid through that money itself. So around 48 crores of that money is from the fire account that we have paid. So typically, you can say that only 27 crore has been the debt used as on 31st December 2024, and going forward, we don't require any further debt increase in debt, because we are with the internal accruals we will be able to open 40 to 50 stores in coming years.
Right. So clearly, I mean, that's an interesting one that we are watching out for as well so far. But thank you so much for joining us on the show and sharing the views. So that's the management of Bazaar Style Retail. If you see in terms of the stock performance, that's slight bit of a downer, but with all these levers in place, whether they'll be able to up their rating at NDTV Profit from a 5.5 is what we need to wait and watch and see. But completely out of time. With that, it's a wrap on this edition of Know Your Company. Stay tuned for lots more.